It was called the crime of the century. Bankers manipulating something called the London Interbank Offered Rate. Regulators stepped in and they developed an alternative rate to be implemented by the end of next year. Jeff, why are bankers currently telling regulators to go stuff themselves with this alternative rate? And what is it? What is it called?
Because it's useless. Leave it to a central bank bureaucracy to create a rate that's meant to replace a very key, crucial part of the global financial and dollar system with something that can't even do the job. Only a central banker could possibly be this monetarily incompetent. And what we're talking about is SOFR, which is the Secured Overnight Financing Rate, which is essentially meant to replace LIBOR as the standard to price almost everything. We're talking about, mortgages, for example, mortgage products. We're talking about cross-currency basis swaps globally. So much of the financial system derives pricing abilities from what's going on the LIBOR curve. And yeah, central bankers have hated LIBOR for a long time.
And so the article that we're discussing, it's called "There is a Hard Truth to This Soft SOFR Arrogance," and SOFR is spelled SOFR. He posted it on November 4th at Alhambra Investments. But Jeff, you started out the article by referencing another article you wrote 3 years ago, and that one was posted on August 10th, 2017. And that's no random date in monetary history. It's an anniversary. What was that article about, and how does it lead into our discussion of LIBOR, SOFR?
Well, on August 9th, 2007, so it was the 10th anniversary plus 1 day, August 9th, 2007, essentially the Eurodollar system broke and it has never recovered since. On August 10th, that became apparent if you were actually paying attention. And one way it became apparent was that the LIBOR rate skyrocketed while the federal funds rate plummeted. You had this major divergence in these two major, or what's supposed to be major, money market rates, both of them unsecured, one domestic, one overseas in Eurodollars. And if you go back and look at the FOMC discussions that took place on an emergency conference call, I believe on August 10th, they couldn't really make much heads or tail about what was going on. Why would these rates diverge? What is this telling us? And what it tells you is that, again, LIBOR is a Eurodollar rate, offshore, global money. Federal funds is a much narrower, limited domestic rate. And so the Federal Reserve was saying, maybe that's not our problem. That's a London interbank. Yes, it's US dollar, but London interbank offer rate, LIBOR. Maybe should the Bank of England? Maybe they should handle this because it's in England. Yes, it's dollars, but it's not our problem, right? And so that's always been an underlying, beneath everything since August 9, 2007, is that the Federal Reserve has been reluctant to step up to the plate and recognize the global dollar system because they're not a global dollar central bank. They're a domestic bank regulator who only cares about the domestic part. And it's only been in specific instances where the Federal Reserve has been forced into doing things globally, like overseas dollar swaps that aren't so overseas. That's when they reluctantly have to admit to this overseas monetary system in dollars that's represented by this one money rate they don't control.
The second instance, perhaps, of when they had to admit to something happening in LIBOR was in 2012. Is that right? When then Chairman of the Federal Reserve, Bernanke, had to go up in front of Congress, and they discussed what was in the news then called the crime of the century, that some of the bankers were manipulating this LIBOR rate. And you tell the story, Jeff, that maybe the Fed saw this as it was conflicted, right? Because on the one hand, you don't want to talk about this offshore dollar market. You don't know if it even is under your purview. And on the other hand, maybe you can kind of get rid of it, come up with an alternative so you don't have to answer to that LIBOR thing there anymore.
Well, remember before 2012, when they started to do something about LIBOR, there was 2011. 2011 was another Eurodollar crisis, which shouldn't have happened, right? Because the Fed printed a bunch of money. They created all these bank reserves through quantitative easing. Yet in July and August of 2011, here again were the same issues, including LIBOR. LIBOR started to rise, the TED spread started to rise, which signaled what? A rise in LIBOR, a rise in the TED spread signaled the dollar system was getting dry globally again. And central bankers in the summer of 2011 were saying, what the hell's going on? We created 1.6 trillion in US dollar bank reserves. Why isn't that enough? Why aren't these bank reserves that we call liquidity and that the financial media has called money printing? Yet it's leading to this crisis where LIBOR, just like in 2007 and 2008, is saying something we don't want said to the rest of the world. And so by 2012, I think, and again, we don't know what was going on, but I'm my own reading between the lines, why all of a sudden LIBOR was a problem in 2012, I fully believe it has to do with that in 2011, central bankers said, enough is enough. This LIBOR thing is embarrassing the hell out of us. And anybody who understands what's going on, it's showing people that we don't know what the hell we're doing. So let's get rid of it. And the reason they decided they were going to get rid of it in 2012, what gave them the cover to do so was that there was an actual scandal in the LIBOR system. Banks had been cheating at the rates that they were giving to the British Bankers Association, trying to scalp a few pennies here and there on derivatives. And in order to give central bankers the cover to replace LIBOR, they didn't call it specifically, but they let the financial media uniformly call this the crime of the century. This is some major, massive scandal, when it really wasn't. It was really this most modest thing. And the reason we know it was a modest thing was because up until 2012, not a single central banker in the world had said a damn thing about it. It had gone completely unrecognized up until all of a sudden 2012, after 2011, Ben Bernanke needs to get rid of this LIBOR thing once and for all because it's embarrassing him again.
Well, I will bet whatever we need to bet here that SOFR will also experience a scandal. Why? Because it's populated and controlled and operated by humans. Welcome to Earth. You don't throw out the baby with the bathwater. Because was LIBOR, Jeff, a government-mandated rate, or was this an organic solution to a complex system on how to price many things into the future over many different periods? And now the government is coming in and saying, we're going to scrap that organic ecosystem that grew up because there was a cancer in this one section. And instead, we're going to just plug it in like it's a Lego, a new rate that, Jeff, you mentioned is just one rate. It doesn't have many tenors. How is that even feasible?
It's not. And right, what they said was, okay, look, if we're going to talk about this nuts and bolts, LIBOR is essentially a made-up rate. And it is. What LIBOR asked banks, and now it's not under the British Bankers Association, it's now the Intercontinental Exchange, or ICE, it asked banks to submit daily what they would lend into the interbank euro dollar market in US dollars if they were going to lend to a generic unsecured borrower. And so it's not it's not based on actual transactions. It's banks telling you what they would do if they were going to do something. And so it sounds like, it doesn't sound like a very good rate. I mean, that doesn't sound like a very good idea to base an entire financial system on something that gives banks all the powers to just make up numbers on the spot. And so in 2014, when authorities decided they were going to replace LIBOR with this SOFR rate, what they said was to justify this switch is not only was there a scandal in LIBOR a couple years ago, there's also this, it's a made up rate. So we're going to use a rate, this secured overnight financing rate that has repo trades in it. It's actual transactions, federal funds, all these other things. It's amalgamation of all these legitimate transactions that take place. And therefore, as an overnight rate, it's much closer to what's actually going on in the market. Not what banks say they might do, but what actually takes place in the marketplace. And so that was how SOFR was sold as, this is why we're replacing LIBOR, because LIBOR is a made-up fairy tale fantasy rate, and SOFR is a real legitimate rate.
It's a little bit like the NFL draft, if anyone is an American football fan here on the air. Before the NFL draft takes place, you've got many people making estimations of who the best players are. And those lists are perfectly reasonable and legitimate, even though in a few days later, there's an actual draft that determines the rank order of who gets picked first. That's because, that's those teams are picking for their own needs, whereas this other list is kind of a theoretical, generic list of all the talent. So it's kind of these two methods, and getting rid of one in favor of the other purely seems like it would be something the banks are not very interested in, and that's what the International Monetary Fund announced just a few days ago. Jeff, you brought up what their paper recently said, and what did the International Monetary Fund worry about?
Well, basically, banks are not adopting SOFR, and why would they? And SOFR, again, as we said, was useless. And this is not something that's just been, something recently. Officials in Britain, the United States, Europe have been talking about this for years. Since they created the rate in 2014 and they launched SOFR futures, I believe, in 2018, they've been pushing the financial system more and more towards that individual rate. And more the financial system is flipping the bird back, saying, we're not going to do it. And the reason they're not going to do it is because, again, as we said before, only a central banker would try to shoehorn this one single rate into a situation it can't be used. It's not suitable as a replacement for LIBOR. And we say that, and what we really mean is that, look, LIBOR is not a single rate. It has a term structure, which means there's a 1 week LIBOR, there's a 1 month LIBOR, there's the 3 month benchmark LIBOR, there's a 6 month, there's 12. There's different rates about different periods. And the reason you want that is because the financial system is complex. Think about how mortgage products are put together, mortgage bonds are put together, for example. You don't just throw a bunch of mortgages together in a pool and package it up tomorrow. You put together what's called in the TBA market, you put together a bunch of loans, you start packaging these things, and then you're borrowing funds in the repo market, maybe up to 6 or 7 months down the road, and you need to be able to price what things are going to be like 6 or 7 months down the road, what funding is going to be like 6 or 7 months down the road, and how can you do that with an overnight rate? You can't. Think about cross-currency basis swaps. A cross-currency basis swap is, I'm going to swap dollars for yen, which means we're really going to swap the yen, the TIBOR rate, which is the Tokyo Interbank Offered rate, for the LIBOR rate, which is the Eurodollar rate. And then we're doing so at 3 month LIBOR versus 3 month TIBOR. How does SOFR help me price a cross-currency base? You can't. You don't, if I wanted even just a basic transaction like buy a Eurodollar or sell forward US dollars in the Eurodollar market, at the same time I buy a Eurodollar forward, to do some kind of merchandise transaction, how does an overnight rate help me price what would be something like standardized 3 or 6 months down the road? It doesn't. It's unapplicable. It doesn't work in the financial system. It's simply an overnight rate with no term structure, and therefore it cannot. It's not that we don't want it to. It cannot replace the entire LIBOR curve, because the LIBOR has a curve, and you can't just organically shoehorn SOFR into something, that kind of a situation. So what that shows you is, number one, I believe central bankers and monetary authorities around the world have illegitimate means in what they're thinking about why they need to replace LIBOR, number one. Number two, they don't really know what the hell they're doing. And it shows. If you're trying to throw an overnight rate intending it to replace LIBOR, you don't really know how the system works. You can't. You're demonstrating your own incompetence in that way. And what the monetary system, the banking system, has said in not adopting SOFR is, look, it's not a choice here. We can't. This is a useless rate for us. You guys have no idea what you're trying to make us do.
Yeah, the IMF spent a few words on this, and you quoted them, and you mentioned that regulators are, quote, worried about this. I went to the report that you linked, and there was another line that I thought was very interesting. It sounded like it was saying market participants rather have liquidity than pursue these regulatory requests. Here, quote, in the floating rate note market, the spread between bonds with LIBOR to SOFR fallback provisions to those without has narrowed significantly, suggesting that investors are more focused on buying up scarce supply of forward rate notes rather than selecting bonds with secure fallback provisions.
Yeah, and I think it's their way of saying, we want them to do this, they're telling us we can't, and we don't really know what to make of it.
Is it a matter of gumption, elan, enthusiasm from the regulators? Why can't the regulators say you must or you're going to jail? because it would wreck the system. But why don't they say
Exactly.
that?
I think that's what's going on here is that they've overstepped their bounds and they're starting to realize they've overstepped their bounds, which is why they keep pushing back the deadline, by the way. The deadline, I believe, initially was supposed to be this year, the adoption of software. Now it's the end of next year.
Well,
And I think that's an excuse, but really it's the lack of the financial system doing what they're saying. And look, the banking system has basically gone with the rules. All of these are, some of them draconian regulations that have been imposed since the first financial crisis. And yet here's one that they're basically saying we're not going to do it. And it's not because they don't want to, it's because they can't. They really can't. And that's why I call this software arrogance, because regulators are pushing for something that just doesn't work, and they're betraying their ignorance while doing so, which is to me is a positive byproduct of this whole thing. Is that once again these idiots are exposing that they're idiots and don't really understand how the financial system works, because they're not central bankers. They do something completely different, and what they do doesn't require intimate knowledge of how the monetary system actually functions. And that should be the trigger for most people listening to this, saying, how can it be that these people who claim to be overlords of the entire financial system and monetary system, printing money with all their QEs, if they don't know a damn thing about it?
That's it, Jeff. Very well put. It's a matter of money supply to help grow the economy, for us to all have good jobs that we can count on in the future. There's not enough right now. The people in charge of this money supply are nebulous. We can't go out to them because they're the private banking networks, but the people that say they're in charge keep dancing harder, waving their hands, but there's nothing that's being generated. And that's what we see in the data, and that you bring to us.
We said before, Xi Jingping, despise the guy, but listen to him. The banking system, maybe you don't like them, maybe you hate Goldman Sachs and all the rest because of whatever reasons, but listen to them. They're telling you a story. Even if you don't like the story they're telling you as a regulator or as just an observer, all of these people are telling you things that you need to pay attention to. And what they're telling you is lack of economic growth because of lack of money. And that's what we see across all these markets. We see in all the data, and we see in, political, social consequences and all sorts of other things. The first 15-year, 5-year plan, all these, they're all related to the same thing. And what they're really telling you at the very first thing, but the very beginning, is stop listening to central bankers.
Have a good weekend, Jeff.
You too, Emil. Take care.